Tesla's stock movements creates cognitive dissonance trading is our story for today. This is Greg for Tesla Fed Insight. Thanks for joining us. If this is your first time, welcome. If you're a repeat visitor, welcome back. I also want to thank our Patreon supporters. Your presence is greatly appreciated and allows us to exist. At any rate, I wanted to, so something happened yesterday, and I've been thinking about it for the last 24 hours, still don't have an answer and still trying to figure it out. And so I wanted to introduce this concept of trading to you because I think that you guys might find it useful. So in psychology, there's a concept called cognitive dissonance. So what that means is that you see something in front of you and you can't believe it exists. So what you end up doing is saying it just doesn't exist. So I'm just kind of stunned because obviously the stock did great yesterday. A lot of people made good money, including myself. And my effort here is to sort of clean up some of the things we found that didn't kind of make sense. I'm going to turn off this light because it looks like it's creating unnecessary. Great. So what happened is that about halfway through the run of Tesla yesterday, when it was about 1460-ish, I had a conversation with a good friend who's an excellent trader. And the problem that came up, which resulted in the title of the show, is that he actually read to me the story that drove the stock higher. And if you don't know what the story is, there's a gentleman who's a senior analyst at Dow Jones S&P, and he actually made a comment that basically the nature of how Tesla's trading bears a strong similarity to how Yahoo traded back in 1999. And if you apply the same principles, Tesla's stock price should end up around $2,200 once it's prepared to enter the S&P. So that's what triggered the big move in the stock price yesterday, which we all made money from. And I'm grateful for him making the comment because it was painful for me to buy calls going into next week at very, very high prices with a whole bunch of unknowns because earnings aren't until the week after. And so it's painful to buy stuff expensive if you don't get the benefit of the push of earnings as well. So after I had a conversation with my good friend, and he read this article to me. And what I was amazed by was as soon as he read it, I started buying calls on Tesla. And the reason I'm bringing this to this show today is that exactly at the same time that I was buying calls, that story was a trigger for him to start buying puts in large quantities. So he has way more cash than I do, so he was able to put in a lot of money. He didn't tell me the exact number, but I know it's big, like more than 20 grand, less than 200, something in that realm. So what ended up happening, as you know, the stock went from in the 460s up into, 1,500 above and then towards 1,550. And so I was amazed. I mean, he's an excellent trader, has a lot of money from trading. I was amazed at why it was that at the exact same moment, two people who know each other well and respect each other have a completely different opinion on exactly what's happening on that stock. And so this reminds me of a famous Indian proverb where there are actually 5 blind men. Each of them are holding a different part of an elephant. And when asked to describe the elephant, they all have a different opinion and they're all right. And so, because obviously there's a trunk, there's the leg, there's all these other parts, and that blind man is describing his component of the elephant, and he can confidently state that that's the deal. So in this case, what actually happened was that there's a guy named Squawk Square who's a really good trader, and a number of people in our group have made a killing off of his tweets and suggestions of what to do with the market. And it so happens that he started shorting Tesla stock right around the 1460, 70 zone. And other people who follow him and have made good money decided to do the same. And so I think they started shorting like at 1500. And so I'm calling this cognitive dissonance trading because anytime you do trading, the challenge that pops up is that there's a concept called a market, and all a market is a difference of opinion about the value of an asset. And so clearly, right now with Tesla, there's a difference of opinion from different groups on the value of the asset called Tesla stock. So when I say cognitive dissonance trading, I mean, I've talked with my friend a few times, and we've had differences of opinion on where we are. But as I said, as soon as I heard that number, I was often buying calls, and here's why. There is a lurking question that's been hanging over the Tesla for the last, let's say, 6 to 8 weeks, maybe even longer, or clearly longer than that, but definitely hardcore for the last 6 to 8 weeks. And that is, after Tesla gets into the S&P, or as it's entering the S&P, what's going to happen with the stock? So we were under the assumption that sort of the premium for the S&P would be limited to between 5 and 20% of the stock price when it was at about $1,000 a share. So most analysts had picked something in the $1,000 to $1,200 range share as what the price value was of the stock. And so I was comfortable with that in terms of a premium of 5 to 20%. And so if you do 20% of 1,000, you get $200. So about $1,250 is the neighborhood that made sense to give it an S&P premium. So I was sort of riding that train, and as the stock bubbled above 1,300, sort of that whole concept went out the window. And in my mind, there's been a question from 1,300 to 1,400 as to, well, what is the premium going to be that comes in from the S&P? And the answer is nobody I'd seen had presented any kind of argument that represent a valid sense of what might occur. And so, this brings up what I call a very dumb moment that I think you guys will understand as I go through it. So what that dumb moment is that there's this problem, which is we've been taught as classical investors by Peter Lynch and Warren Buffett and others that there's a certain process to how you go through evaluating a company. You do your evaluation, then you leverage the evaluation to make a good logical choice. Well, what's really interesting is that this weird thing has come up, which is the S&P. And the way the S&P works is they have a rule. Their rule is we don't care what the stock price is. As long as you're in there, the percentage of the S&P you take up results in the number of shares that they're required to hold. So there's this thing that's going on in a battle right now where the classical investors are trying to leverage excellent research to make the decision on what to do, how to do with Tesla. But on the flip side of it, there's this problem, which is S&P doesn't use any of those metrics. It just says you're in, and we don't care what the price is. You can come in. So randomly, I could just say, hey, S&P, how about 5,000 a share? And S&P's response is going to be, we don't care. How about 10,000 a share? Their response, we don't care. How about 1,000 or 1,500? Any of those numbers, their answer is going to be the same. We don't care, we'll pay it. So you see what I mean by insanity or cognitive dissonance. And so the question that comes up in the cognitive dissonance trading is, how are you guys going to buy something? So think this through. How do you have people working hard with big time calculators, big time computers, big time backgrounds in terms of degrees, working hard to create these models and putting them out there, and all of a sudden somebody walks in the room and says, excuse me, thank you for all that analysis, but we do not care. We're still buying the stock. But thank you. It was very nice of you to do that. So then it becomes like, now wait a second, you guys are crazy. Cognitive dissonance trading, it's crazy, right? Exactly what I was thinking. So now we're in this very interesting pickle, which is the stock price has accelerated nicely, and that's great. I comment, I've been investing, I've studied under some of the best sort of investing people in the world. Ken Fisher, Fisher Investments, I've studied under the people at Franklin Templeton, Forbes Magazine, all these different places. I've read the books, etc. And we all have sort of operate off of fundamental analysis. And the problem that's coming up is the fundamental analysis is getting completely decimated by what's going on right now. So I have to say that I had to buy. So as soon as I heard him read that article, there's this question I've been trying to figure out for the last month and did not have a legitimate answer. And finally, when somebody came up with a legitimate answer, I was like, good, I can finally buy something confident that there is some logic, even if you want to call it crazy, to how this is going to work. By the way, this is a sidebar note, but you guys might want to look this up. There's a Wall Street Journal article. I kind of stopped reading it after Mr. Murdoch purchased it because it's become brutal. But there was an article in the journal probably 20 years ago. And part of the reason that indexes have become so big in the form of the S&P is the Wall Street Journal did an experiment. What they did is they took a trained or an untrained monkey, and the monkey was given darts. So the monkey threw the darts at the Wall Street Journal's financial pages, and they figured out which companies the darts hit, and they created a portfolio from the monkey. So then they started publishing how the portfolio did against the S&P and all these other metrics, and the monkey won in a huge percentage of the cases. So this monkey process brought up the whole question of, well, if we're paying investment managers to manage our money and carefully select stocks and make sure we do well, and there's this monkey that outdid them, how do we justify paying all those fees for management when you guys are getting beat by a monkey? So, excelente question that was just posed, and I'm still like, whoa, this is very deep. So I bring up this monkey conversation because that monkey conversation is one of the reasons why indexes have become so big. So I would say indexes are probably 3/4 of the money placed by large institutions. And I think the S&P represents half of all the money in indexes in terms of who and how they participate. So I'm bringing all this up to you because I call this a cognitive dissonance trading because Squawk Square, who tweets a lot and he does a great job, has been making a lot of people a lot of money with his thought process. But over the last couple of weeks, he's going to be getting killed. And so he has all these, the Fibonacci, he has all this charting capability that is out there. And the problem is, the reason why it's cognitive dissonance is that the exact same techniques that he carefully tweaked and has been using to help himself and others make money, excuse me, has basically not worked. In fact, it's cost him a huge amount of money, including yesterday. So now you see why I came up with this story called cognitive dissonance trading. Because regardless of the amount of time and energy I've put into try to figure out what happened and why, I still come to the same conclusion. We've all been trained that what's happening right now isn't supposed to happen. Hence, you can say it doesn't exist, right? Cognitive dissonance, or you could say, let's try to figure out what's going on here and make money off of it, which is what I'm trying to do right now, and hence the show that we're doing. So I'm very much expecting at the end of the show to have all these people give me thumbs down and say ugly things about this show. But I'm really kind of just laying the facts on the table about how everything works, and the fact that the people who are paid to know a lot about investing are supposed to give you some information and then use that information to do something. The problem, though, is a lot of companies don't enter the S&P of Tesla's size and power very often. He had to go back to Yahoo back then. And the reason is that well-organized, well-structured firms would already be in the S&P. So the stage Tesla's at right now should have happened a year ago, maybe 3 years ago, 5 years ago. But the management process and how their business has been working has not lent it for them to enter. So the other thing I'm noticing here is, what if there's a situation where we all know exactly how to invest, how to manage money, how to do based on the classical methods for doing so. But the problem is there's a 2-week period for another entity that represents a whole new zone of study and understanding. And the problem that pops up is, wait a second, you know, it's nice that you have all that classical training, but if we're telling you we want to buy the stock regardless of price, regardless of the metrics, that is totally cognitive dissonance. Because if you look at CNBC or any of the shows, they're going to bring an analyst on. He's going to say, based on these statistics and this process, this is what the company is worth. He does that all the time. He or she will do that all the time. The problem is that that stuff don't apply right now for the next 2 weeks. And so the problem becomes then, okay, if that doesn't apply right now, what does apply is the great question. and what does apply, and how do I make money in that environment? And the answer I'm coming up with is why I bought the stock yesterday, because one of the other challenges that's happening in any trading situation is the fact that the environment can keep changing on a regular basis. And if you try to apply process that was really effective a while ago, you run into a huge problem, which is the process doesn't work because you're in a different environment. So I believe right now with Tesla, the best thing we can go on as to what this thing is going to do is say, hey, 2200 sounds about right, you know? And so therefore, we are $500 light against what the process is. And so the gentleman who made the comment, and he did it off cuff because he didn't hit us with a whole bunch of data to support the argument. But because he's S&P, great firm, and it's Dow Jones, great firm, we really have to embrace the logic of what he's arguing. So the net of this whole thing is that everybody wants to be brilliant and say, we know what's going to happen, and here's a whole bunch of data to support the argument, and now we can invest against it. What about somebody saying, hey, this is a one-off that we're seeing once every 20 years or so? And so there just isn't a lot of data on how to trade it, how to manage it, but there's a lot of money to be made in it. And so it's amazing to watch the number of people, be it big hedge fund managers or regular, you know, large dollar managers, even small people, trying to catch the backdraft or downdraft of the stock, when in fact there may be $20 or $30 pullbacks in terms of nervousness, but everyone's trying to handicap what the number will be when we enter S&P. And the answer to it is that nobody knows. And the closest we have is what the S&P analysts actually had to say about Yahoo in terms of the structure of the company and anticipatory of its entrance into the S&P. So I'd have to say that part of the game of great investment talks is that I'm smart, I've studied, I can answer a question for you that other people can't. And guess what? Nobody has the answer here, which is why the stock is moving so wildly. So I'm not going to belabor all the points that I've made. To be honest with you, my screen size is so small, I can't even read the comments you guys are making. So what I'm going to do is respond to them afterwards. I apologize for that. But basically right now what's happening is that the best we can guess is 2200 is the target for the stock price right around when earnings hit. And if it gets there and you're in on puts or calls or even owning the stock, you get rich. There's one last comment that he made. This is the gentleman from Dow Jones. And it's so outrageous that I can't, I read it, and it's so outrageous and unbelievable that I'm having a hard time believing it, and I read it. So what his comment was, if you go back and you look at Yahoo as it entered the S&P, after its entry, it had 5 days of increasing value that resulted in a 64% increase in the value of the company. So that's how he got to the numbers on Tesla and where its stock price should end up, is based on S&P entry and the impact on the first 5 days of how it hit the stock. So so basically, you know, so the problem right now is myself and a whole bunch of other people are sitting there going, well, wait a second, what about all the classical fundamentals of how people evaluate stocks? You should be thinking about this, Mr. S&P, because we've done all this research and we've got all these degrees, and therefore you need to do what we're telling you to do. And Mr. S&P, with the largest amount of capital of any entity on the face of the planet, is saying, thank you very much for all of your degrees and research. We don't care. We're buying. And we don't care what the price is. As the time comes, we're still buying. And so I'm seeing these comments coming across on other shows I've done recently. And I thought it was funny because there's a few people that have pointed out that the stock price is going to fall after the S&P entry. You know, give it a little period, it's going to fall backwards because people will come to their senses. There are other reasons they'll do it. Yeah, that kind of makes sense, but there is one little problem with that. I don't know the numbers on other entities, but there's an entity called CalPERS, which is one of the largest investment managers in the world that manages the retirement for California employees. Now, CalPERS is a very interesting place because according to what I read of them about 5-6 years ago, their monthly intake of cash is about $300 million. This was 6 years ago. Theoretically now, let's say they take $600 million in a month based on number of employees that are contributing to it. So that's $600 million times, let's say, 1,000 places if you add up all this, right? Or it may not be that big. $600 million times, let's say, 50 places if you look at all the money that's coming in. In theory, half of all that money goes in and it enters the S&P on a monthly basis. So if you're a large company and a relatively large market cap, the weighting that you get in the S&P can result in a big block of that cash hitting your stock on a monthly basis. That's why the S&P is so big, is that there's a huge amount of cash inbound on a monthly basis. So not only do these S&P people not do their homework and do all the work we did to figure out what the deal was, but they're saying, number one, I don't care what the price is on the day that that we hooked this up. They also have another comment, which is not only do I not care what the price is today, I don't care what the price is a month from now, 2 months from now, 3 months from now. Why? Because we've got net inflows of cash that have to be allocated on a monthly basis. So now you understand why I'm saying cognitive dissonance trading. How do you trade into that, right? Because you're sitting there saying, I've got these charts, and the charts say the stock's going to do this, and it's done this in the past, and the charting gets blown out by these guys at the S&P saying, thank you for the chart. I don't care. I'm buying. So that's the deal. So I'd like to put a bow around this and say, I know everything that's going to happen. But there is one thing I know. All Tesla has to do is make earnings. And Mr. S&P is going to say, I don't care what the price is, I'm buying. So the question for you, my friend, is can you figure out how to get this stock up into that nice 5,000 realm so that Mr. S&P still has to buy it? In fact, what's even crazier about this whole thing is the higher the price of Tesla's stock, the more of it the S&P has to buy, because Tesla's market cap is part of the weighting process for the S&P. So in theory, the higher the stock price goes, the more Mr. S&P will buy. So that's even crazier. So if you're a chartist and you like Squawk Square, I think he's a smart guy and he's done a great job. I think you might want to suspend your chart process for this, because this is going to get very ugly in terms of the separation. There's a reality we've all built up, and we share the reality with each other, and this is how it works. But the problem right now is there's a reality that Tesla has relative to its S&P entry, and Elon is laser focused on this happening because he makes it him perhaps the richest man in the planet. But I just want to note to you that this is the definition of cognitive dissonance, where you can see something and say that doesn't exist because we know all these classical principles. And then Mr. S&P walks in and says, thank you very much. I don't care. I'm buying. So where does this leave us? I think it leaves us in a position where do not be surprised to see this stock make a run next week that's historic. And if you choose to sit it out, you're losing, I think, perhaps the chance of a lifetime to make a killing. And it's all driven by the fact that this trained monkey was beating all those analysts. And we have, we now have the index world dominating because it's low cost, and everybody wants to just track the S&P because the S&P's return on investment tends to allow them to beat something like 80 or 90% of all the regular investment managers. So why pay more to have your money managed by an investment manager when you can just put it in the S&P index, don't sweat bullets, have very low fees, and and make a lot of money? So it's a very interesting set of things here. Again, everything I've said comes from training. I've been in the investment business on and off for the last 40 years, investing of different types. I worked at Franklin Templeton Group. I worked at Fisher Investments. I worked at Forbes Magazine, among other places, just learning about the markets, learning how to invest better, etc. So you don't have to attack me individually, just attack the logic. But because I hate when you guys send me stuff that's mean and nasty, and it's just the facts of what's happening has nothing to do with me. So the rise of Tesla's stock price has everything to do with the S&P, and you can say mean things to me about what I've said, but the reality is that all this is sponsored by the S&P screwing everybody over in terms of all the chartists are screwed, all the shorters are screwed, all the people that are working on classical investment stuff is screwed. So again, I want to thank all of you for joining us. I appreciate your sitting on this conversation on cognitive dissonance trading. But like I said, if you're going to send flaming email, please send it to the S&P, because it's not me that's doing this. I'm just explaining to you what's happening. And when it comes to all us pontificating, there are a lot of people that'll sit there and go, I know everything, and therefore you need to listen to me. Well, guess what? Not everybody knows everything because there are people like the S&P that know things about what they're going to do that they make transparent because so many people are involved in it. And the issue is, can you battle the S&P with your logic and thinking? And so if you're going to send a flaming email, send it to them. Do not send it to me, because I'm just trying to create a healthy dialogue about what's going on and therefore how to make money from it. So at any rate, thank you once again for joining us. Just a reminder, we usually have our health tips. I wanted to encourage you to do 25 leg lifts a day per leg as a way to strengthen your quad muscles. Also wanted to encourage you to consider a 5-2 or other diet. Also wanted to encourage you to think about, I like to do multivitamin, but I was told fish oil is the best for the daily. Also wanted to encourage you to consider weightlifting a couple of times a week as a way to increase bone density. And we also wanted to mention at least a 30 SPF if you're going to be out in the sun, and no more than once a week for fried foods. At any rate, I really appreciate all of you making comments. I can't see them at all. So basically, I'm going to get the feed and then look at your comments and respond to them off air. But we really appreciate your taking time out to view. And I apologize that I don't have a neat bow around what we did today, but I'm just telling the truth. So if don't hate me for that. You don't have to send me flaming email. Send it to the S&P. In German, we say tschüss macht's good. French, au revoir. Lehitrot in Hebrew. Choda hafez Farsi. Zdravstvuyte, hello in Russia. Ni hao ma, hello in Chinese. And hey do, Swedish. And in Jamaica, we say enough respect, walk, good man. Thank you for joining us. Have a great day, and bye for now.